Fed just raised interest rates by 75 basis points, which is the fastest increase in rates in many years. Hi everybody, Coburn Shepik here from Dovetail Investment Group. In today's video, we will be discussing how rising interest rates affect commercial real estate. Just to recap, interest rates represent the cost of borrowing money and are ultimately determined by three factors: Federal Reserve, the U.S. Treasury, and the banking industry. Lowering interest rates encourage consumers and businesses to spend and invest, which ultimately can result in a boost of asset prices. Raising interest rates makes credit less attractive and ultimately slows down the economy. The Fed's goal is to keep rates at a healthy level that supports the economic growth without letting the economy get too hot or too cold. So why are interest rates rising? During the COVID-19 pandemic, the Fed reduced rates down to nearly zero to help boost the economy and incentivize growth. At the same time, the supply chain ultimately stopped, which in turn created a massive amount of demand. And when supply can't keep up with demand, inflation increases. The Fed is now raising interest rates to help reduce inflation. So how do interest rates affect real estate? Raising interest rates impacts capital flows, which ultimately leads to an increased cost in development, such as labor, materials, etc. And this tends to slow down growth as developers may choose to hold off on developing while waiting for lending to ease. There is some historical correlation between cap rates and interest rates, which is the risk premium, which ultimately affects the value of real estate. Are they exactly correlated? No. But if interest rates continue to rise, that could put upward pressure on cap rates as investors demand to reduce their cost for yield. A forward outlook. We have been experiencing massive expansion due to very low interest rates alongside a major imbalance in supply and demand. But with interest rates now rapidly rising, this will put some pressure on those operators who are needing to refinance or who are actively allocating capital. If we are talking about residential, home buyers can lose 10% of their buying power for every 1% increase in rates. We are already seeing impact from the recent increase in rates, which has reduced sales volume, and at the same time, this is putting an upward pressure on the increase in rental property. There's no way to tell what the future holds, but knowing the goal of the Federal Reserve, most likely interest rates are going to continue to climb in the short term to reduce inflation, which will put upward pressure on cap rates. We continue to follow the fundamentals and seek growth opportunities, all while controlling the risk.